Hello everyone, this is Ronin Blue, and for those that don't know me, this channel is all about how my girlfriend and I just started our financially independent debt-free journey since paying off our mortgage. With my newfound freedom, I talk about how we made it happen, the forms of passive income we have, our thoughts of early retirement overseas, personal thoughts, and general financial issues. Today's topic is on dividends, the compounding king part 2. Watch the second section of my dividend vlog and see whether you'd like to start investing in it. Just as a disclaimer, the information provided is a general guide and to be used for educational purposes only. So in continuation to my previous dividends, the compounding king vlog, we ended off wondering how we know whether dividends are sustainable. Well, let's say one company has a 4% dividend yield while another has a 2% dividend yield. How would you know whether that 4% yield will be more sustainable than a 2% yield? Well, you need to look at the payout ratio. If a company earns $100 million and pays out $30 million in dividends, the dividend might be safer than if a company had paid $90 million in dividends. Whether a company will keep paying its dividend or even increase it is dependent on their dividend payout ratio as well. So it's the amount of money the company pays out in dividends divided by the earnings for that same period. A 1-to-1 ratio, 100%, means the company paid out all of its earnings and dividends. Anything over 100% is clearly unsustainable in the long run, and either the dividends must fall or earnings must rise. Companies that don't innovate or improve themselves will likely not survive. So the reason to buy individual stocks other than dividend ETFs would be that you don't mind a bit more of that challenge. And you'll also likely grow a profile of dividends that offers a higher yield than in a dividend ETF if you choose wisely. If you decide on buying dividends, you should also ask yourself what the taxes would be for dividend investing as well. In the United States, any qualified dividend is taxed at a lower rate than wages, and the maximum qualified dividend rate is 20%. The majority of the dividends would be qualified, but you do need to look at the holding time frame. It could be at least 60 days including the ex-dividend dates for common stock, and at least 90 days including the ex-dividend date for preferred stock. Falling short of this time frame would mean dividends will be taxed at normal income rates. But for non-qualified dividends, like from LLCs and REITs, are not qualified. The dividends are taxed at normal income rates, which can rise to nearly 40%. But keep in mind as well that dividend investing is usually best when interest rates are low, and a buy and hold strategy may see some disadvantages when you take a look around and see certain alternatives that become more attractive. It all depends on your discipline in sticking with this strategy or not, longer term. Some may say that because of the taxes involved, it's a poor strategy to invest in dividends, but you can invest through a tax-free account like a Roth IRA where the dividends are not taxed and there is no change to your capital. You can further take advantage by reinvesting the dividends as well. Here are some more advantages and disadvantages to dividend investing, while the debate goes on to whether it's a good wealth-building money-making strategy. An advantage would be that dividends are like starting up a compound interest machine, especially if you reinvest the dividends over the years. Each year, you'll wind up with more shares as the dividends are paid. So when you need the income, you'll have a larger capital, generating more income than if you have just received a dividend in cash. It helps in beating inflation as well. You want to own these stocks to beat inflation, always staying ahead of it, especially with companies increasing their dividends every year. Companies also rarely decrease a dividend payment as well. By doing so, it's interpreted by the market as a strong signal that the firm is having financial difficulties. Some companies offer investors dividends that could be automatically used to purchase more shares of the stock instead of receiving cash payments. They are called dividend reinvestments, where you can avoid taxes this way. Dividends aren't usually taxable until the stock is sold. But if the dividend is reinvested and then the investor gets a cash payout instead of stock, it will create a tax event. So beating that inflation, having that solid growth, and compounding returns would be reasons for dividend investing. But let's look at some disadvantages. Dividend investing is a great source of passive income, but there is that issue of capital. It's only going to pay off when you have lots of money to invest. If a particular dividend only has a 2 to 3% return, you need a lot of capital to generate any sort of meaningful income. If you have $1 million dividend stock portfolio, it's only going to bring about $30,000 a year. You can't touch the principal either. So it takes a lot of time to grow as well. There's a lot of risk involved, and recently dividend stocks have simply gotten too expensive to be worthwhile. With the combination of riskiness of high-yield dividends, low capital accumulation, tax implications, and time, some say younger investors are more likely to benefit from growth stocks than dividends. But as you become older, you could always shift some of your holdings into dividends. But for those that want to start off with strictly dividend investing in your earlier years, you could take advantage of compound interest. Dividend investing is not always the best or the worst decision. Some may prefer dividend investing over capital gains investing. But regardless of your choice of investment strategy, it is important to be aware of the dividend yield traps and how dividend-paying companies may not be as stable as commonly regarded. Dividend investing has worked out great for us in the last 14 years of picking and choosing our own stocks, and as our balance increased, we actually branched off for other opportunities like purchasing an investment property with its mortgage now paid off and are currently renting, purchasing those ETFs, high-risk stocks, and some cryptocurrency. So in my opinion, yes, dividend investing is a great start, but focusing on it 100% is not the best of solutions. As you move forward in your investment world, you'll want to see whether other investments might be worth your time as well. But while you do that, I would suggest you always keep those dividends and routinely invest into them. It's a great starting point towards your financial independence. Well, tell me what you think of dividends in the comment section below. If you like this vlog, please don't forget to give me a like, subscribe if you haven't already, hit that notification bell for more of my content here. Thank you for watching my vlog. I hope you have a great day and see you soon.